All right, guys, this is Foundations of Trading. How do we get a real advantage? This is going back to what does it mean to even have an advantage in trading and the implications of having an edge. That's what we mean by advantage. We're trying to define what an edge is in trading, and then we're trying to sustain that edge. Now, there are some correct and incorrect definitions of that edge, right? If we get active, but not active with an edge, then our activity is not productive. At the same time, we can come to think that an edge, when properly applied, means that we will always win. Well, that's not true either. Traders with a consistent edge don't always win. And these different definitions are actually very important because they affect the way that we think about and act in our trading. And I'm going to define here that what we think and what we do are very connected, right? I always teach, I hope, I try to, from a place of skill set and mindset and skill set, because somehow linguistically we've detached one from the other, and they're not really detached. They're the same thing because they're what happens in us and what happens through us. So these definitions matter, and what I want to get you today is a better, clearer sense of how you apply an edge in your trading, but also the things that undermine you from consistently doing that, right? Again, if you achieve that, the goal is that you grow your equity curve over time, but it doesn't ensure that you will not take any expenses. It just is aiming to ensure that over time we are getting ahead. And I think this is important. In my time with students, this is one of the biggest things, right? For me, it's a lot of people who are really just getting started and getting used to things. But as we get further down the line, I find that we can leave behind some of the most important, most foundational things. And interestingly enough, some of the students who advance the most, sure, they may learn advanced techniques and setups, options, multi-leg strategies, etc. But the basics are still, the foundation is still very much intact, very much visible. And that almost in a way, it actually makes trading just easier because they haven't forgotten where they started. And of course, I'm going to go over what I mean by that. Now, as we're going through, I want to make sure I keep this chat up here. Gordon says, Florence, Arizona is getting cool. Omaha just had a hard freeze, too cold. Yeah, Misty just said the fall weather finally. I have a sweater and sweatpants on. I went for a walk this morning and it was absolutely glorious. No AC on, window open all night long. Couldn't be happier about that. All right. All right, what are we going to cover here? All right. Why it should never be gambling. And it can become that if you're methodical. It can become gambling if you're not methodical. Yeah, there we go. I just read it wrong, right? And it can slip into that again later. Everybody, for the most part, everybody on here's probably heard that, right? It shouldn't be gambling, or you've heard me say it. But it slips back into that over time, or we let some trades get through that really lean more to that side. So I want to cover that. How to trade the trend and not make it more complicated than it needs to be, right? In momentum, it doesn't matter what time frame I'm looking at, what time frame I'm trading. When the market has significant momentum, trading's always easier. This is why we like bull markets, right? Early bull markets, if I go back and I show you, or even not even early, I mean, we saw post-COVID, right? Which I know there are some that argue that that basically was a new bull market. I'm not so concerned about the definitions right now, so as to say reliable, predictable, repeatable. It's what we used to always say in step one: reliable, predictable, repeatable. You just don't move on from that. You know, I will have weeks where I go, hey, what happened this week? Like, things seemed easier. Momentum, 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 momentum. Either stocks that just had crazy momentum, right? Consistent trend, or the market had consistent trend. Right now, we're not seeing particularly consistent trend in the micro of the S&P, more in the macro. We can take a look at that. You look over since the beginning of the year, we've made pretty consistent lows, pretty consistent highs in this downtrend. Day to day, it's felt pretty wild because the swings are very volatile, right? And we've seen that this week. But that makes it even more important to come back to that foundation of looking for momentum. And depending on the skill set I'm applying in terms of options, I like to say options gives us options, right? Because we can apply options in a way where we don't need as much momentum. But when we're talking about directional trading, momentum is king. That's what we want. You say, well, Blair, that's a pretty obvious statement. If stocks would just keep going the same way, that sure would be a lot easier. And I would say to that, exactly. Exactly. Sometimes we're looking at trades and we're going, man, we're just zoomed in like a microscope, trying to find these very technical pivots. And while I don't have an issue with that, and the higher skilled technicians among us will be able to take advantage of that, I'm like, okay, great. Let's add that on to the foundation, not forget the foundation, which is that the trend, when there is great momentum, trading is easier. And who said it had to be harder? Well, it does if we feel like we need to trade when we don't see that momentum. Now, that's a very real point, and we'll get to this. But what about just being picky? What about just saying, well, all right, it's not giving me what I want. I'm not going to do anything. Well, yeah, Blair, but I mean, I want to be active. I got to make some money this week. Okay, well, let me ask this question then. How many of us are making the money we want to be making by taking the trades that are harder than what I just described? It's just food for thought, right? It just highlights. Now, we want to grow. Like I said, we want to add to that foundation so we can take more opportunities. I just don't want us to lose sight of that. And that's why I said here, more complicated than it needs to be. All right. Over trading, potentially one of the most basic and common ways to undermine the edge that you may actually be applying correctly, right? Over time, you might look at your trading results for a number of reasons and go, oh man, I don't know if I'm applying the edge correctly. Well, I don't know. Maybe you are. Maybe you are, but maybe a few of those times meaning trades you've taken, they did not have that edge, and that can be enough to set us back in our equity curve. I'm not saying you took another trade that had all your rules in place and you took a stop loss. No, that's just part of a sample size. That's just part of a sample size. But if I'm over trading, I'm taking unnecessary risk and I'm subverting all the work that I've done in my sample by taking on trades that maybe fall more under number one there, or even maybe number two. All right, here's another one. Position size. We're coming at this from a little bit different, right? Having that foundation. Maybe I scale up. Maybe I scale up too quick, right? When should I scale up? That's really more of what I want to talk about there. Right? And there it is, the scalability, excitement and the risk, because both are present. Sometimes the excitement is the risk. Okay. So like I said, let me, I just want to, oh, I see there, Francis. No worries, man. No worries at all. Shout out from Chicago. There you go. All right. All right. Trading is never, geez, you can see where this is going, right? And I said this already. Guessing, gambling, going for it. Man, I'm just going to go for it. Well, sometimes when we execute a trade, it may feel like we're just going for it on some level. But because we've done the diligence of what we need to do, that's the separation. It's not that we know what's going to happen, because we never actually know. Even when we think we know what's going to happen, we don't know what's going to happen. We can know this. We can know that we limited our activity to a set of rules and criteria that if we don't limit them to that, then we are gambling. And if we feel like we're going for it under those conditions. We want to talk about those conditions, but this is where we're not actually going to know what's going to happen. So are we always guessing, gambling, or going for it? No, because the basis of these things is not based on knowing what's going to happen. This is why people think trading is gambling. Well, because Blair, you can't know what's going to happen. No, I can't know what's going to happen. But I tell people all the time, if you go into a casino and you count cards, they will kick you out. They believe in your edge enough where they aren't going to let you play. If they didn't really believe in it, they'd let you play. Well, Wall Street's going to let us play. They're just going to assume that we're not disciplined enough to consistently employ an edge. I don't even think they think we can't find one. I just think they probably don't expect us to consistently apply it. Right? There's probably many other reasons why they don't really care what we're doing, and we don't care that they don't care. What we do care about is whether or not that piece of the puzzle for us is in place. And so the point here is not that guessing, gambling, going for it. The point is that the difference is not knowing what the stock is going to do, what the trade is going to win or lose, but whether or not I applied the steps prior to entering the trade that are necessary for me to not need to know what the stock is going to do. That's the difference. And that is the foundation. So what makes the difference? Okay. Here's the point I want to make through today's webinar. And I haven't quite said it like this before, I don't think. I'm just starting to really feel the, I'm looking for the language here, guys. I think the edge of trading has been divided into two pieces, internal and external, and I just don't think that helps us. I think it's really just both, right? Now, what are those applications? Well, we're going to talk about that. But it is both. It is both. Because some of us just don't have the information we need. What are the external applications, Blair? Tell me what they are. A, B, C, D, right? X, Y, and Z. And then I can go out and I can execute, period. Okay, that's great. But what I find for most of us, that's not enough, right? So we're going to cover that. It's about narrowing our focus. What is my specific criteria? And I only go for that. I don't get pulled out of that, right? Unless I'm entering into a new area of my trading where I'm practicing something, a new strategy, a new approach, right? A new entrance criteria, a new exit criteria, in this trade on the 30-minute time frame. When this breaks this moving average, that's when I'm going to exit, right? Those kinds of things. We're adding those technical things in there, and that creates that's something that we're adding in and practicing. But in our actual trading, whatever we have decided as a rule, we're sticking to only that. Some of us are newer, some of us are not newer, and we're still in a place where we have 16 strategies, and maybe we're just trying this one here, and then we're trying that one there, and then let me see how this one goes here. I think I could probably do a credit spread. Maybe somebody talked about a debit spread on the live trading hour yesterday. So I'm going to do a bearish debit spread here. I'm not getting data. I'm not getting consistency. I'm not trading the same patterns. My focus is not narrow enough. It doesn't have to be one strategy, one pattern, that's it. But I do want to narrow that down, because how am I going to measure whether I'm consistently applying an edge if I don't do something consistent, right? I mentioned this already. I won't go over that again, right? It's not about getting it right. We're not right in trading. Some of you guys have heard me talk about this. I won't go into the whole teaching here, but what makes the difference? Like, what really makes the difference where we're not gambling while we're narrowing our focus? We understand that we have internal and external applications that separate us from randomized results. We are going to get what feels like random results in one trade, but over a series of trades, when I consistently apply the same approach, I'm putting the math in my favor. And we're going to talk about that specifically. Trading also isn't about getting it right. You're not going to get a trade right. You don't know what the trade is going to do. In fact, I think I said that. You don't know what the trade is going to do. I don't know what the trade is going to do. It does not matter how pretty that downtrend is. You have no clue whether it's really going to continue. Now, you may feel very confident. The probabilities are there. That's good. We want that. But that confidence can be violated by market action. It is the gorilla. It's going to do what it wants, right? Now, at the same time, if I don't actually know how to get it right, meaning I made money, right? Because that's how we define right. I made money. Well, if we define that by right, what else do? We define wrong by losing money, or I should say, we define losing money by getting it wrong. Oh, I was wrong about that one. Well, I just think that's a slippery slope, you guys. I don't think that helps traders. I think that erodes confidence. I said internal and external. I think that erodes confidence, because you're telling yourself you're wrong about something you could never possibly be right about. Now, sometimes people say, Blair, that, I kind of like how you talk about the philosophy, and I get that, but I'm not really talking about philosophy here, although it may sound that way. No, I'm talking about the confidence that you are either increasing or decreasing in your trading. And if you can't possibly get it right because you don't know what it can do, when you tell yourself you got it wrong, a lot of times I see that erode the confidence of the trader, which absolutely translates into their results. Jeffrey used to talk about this all the time in TGE, right? Students getting small goals, small monthly goals. I mean, we're talking not life-changing amounts of money in these goals, guys. But they consistently hit it. Guess what happened? The equity curve is there, but it's minimal because the goals are so small. What is happening? Confidence. Confidence is happening. And confidence in trading is an exponential factor. So I'm not just talking philosophy. If the edge was always in a system, then every person who knew the system would always have an edge. But that's not the case because we're human beings, right? Confidence is market currency for the trader. Somebody probably needs to write that down. Confidence is currency, right, for the trader. So we know that we're right by applying the system consistently and trusting that we do what we said we were going to do, right? It's also about making things simpler than perhaps we've made them. And we'll talk about that as we go. I said I wasn't going to teach on that. And there you go. That's a big one. That's a big deal, right? All right. Just checking the comments there. Good trading mindset is the responsibility necessary for a good trading skill set to thrive. If we're starting, this is crucial. If we're active, we want to check in. If we're already doing well, this can take us to another level. Okay? It's just to illustrate that they both give us an edge, right? They're both important. They're both important because they're not separate one from the other. Okay? Discipline without proper application is impotent. Right? Meaning I have discipline, but I don't know what to do. I don't know what to do. Okay, application without proper discipline is chaos because I can't be consistent. I don't know what to be consistent in. I know what to be consistent in, but I don't do it. Neither of them are helpful. That's why these two are so important together. Okay. So how to really eliminate this? We can go down a little list here. These are really compiled from the most common questions that I'll ask when a student shows me a trade. It's not limited per se to just this idea of gambling. What I really mean when I say eliminate gambling, and if I honestly made this slide again, I would probably change it. I would focus in on the fact that how do I eliminate taking trades that don't fit my edge? Look at the other side of it. I was going to say, look at the other side of the coin. I think it was Warren Buffett who said, there's three sides to every coin, right? There's one side, there's the other side, and there's the edge, right? The edge is definitely smaller. That's what we want. We're not just trying to get, the stock's going to go up or the stock's going to go down. That's one side. That's the other side. Now, we're not going to know. So let's stay on the edge. That's what this slide is about. All right. How do I eliminate? How do I narrow down? What does that look like? And I admit that some of this in this part is going to be more broad because you guys might be applying different strategies. This is not necessarily strategy specific, right? You may be using different strategies. But whatever the strategy is, when you're working on that specific course, when you're looking at, some of you guys are buying stocks, some of you guys are trading iron condors, right? Some of you guys are doing things in between. So I could teach on one strategy here, but that's not necessarily the overarching point, okay? Here's a bit of a checklist. And again, these are the questions I find myself asking the most when a student shows me a trade and wants to know, what do I think about this setup, right? Have a premise for why now. Why this trade right now? It sounds obvious, okay? But I find that when pressed to express, especially verbally, why this trade right now, there are a lot of times when the trade that we are looking to take is too close to, I think this is going to do blank. Like, that's the premise. I think it's going to go up. I think it's going to go down. Okay, let's go deeper. Articulate why now. Why, technically speaking, right? Not news, because we're short-term traders here, right? We're not primarily looking at news. Why now? What is this goes into our workshop material. What is the premise for that trade? Why is this trade the best trade that you can find for your dollars, which are soldiers going to war for you right now? If you can articulate that, okay, then you're getting across that bridge. But if I can't, and I haven't done that at all, there's a very good chance that it's going to be heavily emotional, heavily intuitive, which I don't mind a degree of the intuitive in trading. I think that's a real factor. But for my analyticals, right, I'm specifically saying why. Okay. And of course, we have 3 legs of the trading table in our system that really help us start to narrow that down. That's a good place to start, right? I have 3 legs to the trading table, but really looking specifically at that technical leg, this is why. And we're going to talk a little bit more about this, but I am trading in the trend. I am moving with momentum. I have a good buy point. I have positive risk return in this setup, right? I have conservative and aggressive profit targets set. I have these things in place for this trade right now. This is an outperforming or potentially underperforming industry group. See, I'm starting to go down a list of reasons that are objective and technical to say, this is why I'm doing this now. If I can't state those things, then I haven't properly recognized whether or not they're present. And I want to make sure that I do that, right? Simple. Don't graduate from a great pattern. You can make a lot of sense. This is how I've actually felt lately, even in this bear market. You can make a lot of sense and anchor yourself to something very simple when you remember that I don't graduate from a great pattern. When I go out to the trading account in the morning, that's what I'm looking for. I'm looking for a great pattern, right? I'm starting there. Now, if I've built on some technical skills, there was a trade we looked at, this is 2 weeks ago, on Netflix. I just mentioned it in the live trading hour with Jeffrey. It was just if you look at Netflix, it's just channeling sideways, chopping sideways. It came up into a gap level and then dropped beautifully off that gap level. Actually, it went down for about 5 or 6 days. That wasn't necessarily a stock in a really concrete pattern. It just moved up, hit a strong technical level, big gap, and it failed. Right? Now, we talk about those things. We introduce those things. And the danger of that is that we open the door to forgetting the foundation of what we're doing here is great patterns. And we add to that. We don't, if I can say it this way, we can learn 10th grade math, right? Well, we move on to new concepts in 11 and 12 and into college and so on, but we're building on the same fundamentals and foundation, right? And I don't want us going out there and thinking we need to find every little technical move like that at the expense of the fact that one of the things that makes great sense of what's happening when you don't know what's happening is the same thing that made sense of what was happening when we didn't know in our very, very first step one class. It's that stocks move in patterns, right? For some of us, this is a peaceful thing. It gets us back to a real anchor, and it gets us out of trading that just really is murky. It doesn't have much of an edge, right? I mentioned this already in the premise for why. Always look for a trade that has positive risk return. When we're speaking directionally here, right? Our probabilities in some of our strategies where we are sellers and not buyers, right, is going to look a little bit different when it comes to positive risk return. Okay. I could add in though, if we're looking for a specific probability of profit, right? If you're selling options, what delta are you selling? That delta is the probability of that stock going in the money, which as a seller, you don't want in most cases. Maybe you're selling calls and you want to be called out. But your delta, as a buyer, we learned the delta is that this is what I'm going to make, approximately speaking, for every dollar movement in the stock, right? That's the trade-off for the leverage of purchasing the option. It's not one-to-one unless we're really deep in the money. Okay, but as a seller, you could add that in there, right? So not necessarily looking at positive risk return. It just depends on how you calculate it. Okay, but it's a little bit different for sellers. But we still want to maintain that edge. When I do certain multi-leg strategies, I'm looking for an 85, 90% probability of profit. Now, obviously, I'm taking less money to do that. I'm not saying that's a hard and fast TRADEway rule, but I am looking at the probability of profit when I'm taking a trade based on standard deviation, market maker, expected move. I want to see that thing pretty high. So I have some ways of approaching positive risk return. What's the math saying? Because probability of profit, is calculated off of math. I'm bringing in objective mathematical formulas to help me go, okay, this one is me risking, I'm going to use some basic numbers. We're going to look at it in a second. I'm risking 1 to make 2, right? That's how we've always framed that. And that's the simplest way to say it, right? Consider position sizing is what that is for the road conditions present. By road conditions, which is why we see our driver here, is really what's going on in the market, right? We mentioned it's getting colder. Well, the weather's changing. Anybody notice the weather change in the market? Right? The weather's not the same. And the weather, where I grew up, some of you guys in the Midwest know this. They say, you don't like the weather, wait 10 minutes, right? Who feels like that in the market right now? You don't like the weather, wait 10 minutes, right? So let me go back here if I can. All right, won't let me. There we go. We want to consider the weather, right? We want to consider the weather. So position sizing right now, you'll hear us say it on every webinar. You guys are probably getting sick of us saying it. Position size, position size. I've said this before. I talked to Dr. Jim over at Tastyworks. I don't know if I'm pretty sure I've never met anybody who knows more technically about options than he does, except for maybe Tom Sosnoff. He said the number one thing he's seen in all his years of trading is that people trade too big, right? Trade too big, or we trade smaller and then we position size up too quickly, and that eliminates our edge. We'll talk about that before we finish today. So considering that position. So a lot of this is just really understanding, well, what's my approach to the market? And every time I trade, am I checking in with that? See how I said that internal and external, right? Yeah, Blair, we've heard this before. This is how we, yeah, okay, well, are we doing that in every trade, right? And this is the question I have to ask myself. Okay, was that a series of trades where I didn't really have that in place? Or I did consistently, right? And, part of this, and this is this last point here, is the consistent job of the trader. This is what I love we get to do as a community, is knowing that, quote, road conditions, they just don't stay the same. So what we were doing isn't necessarily going to be what we are doing, and what we are doing isn't necessarily going to be what we will be doing. We keep shifting and changing because the market changes. The conditions right now for a typical stock trader, certainly not what it was last year, right? Sometimes our edge is going, I'm not going to trade until I have an approach that I feel confident about in these conditions. Somebody mentioned the other day that Ross still consistently paper trades more than he trades real money. That really impressed me. I still paper trade. I don't paper trade that much. The thing is that, well, yeah, but I don't want to paper trade because I don't make money when I paper trade. Well, yeah, but there's that internal, external again, right? The thing that's getting in the way there is the internal. Because if I don't know how to approach the market right now anyway, right, then I need to be testing something, right? Obviously, us coaches want to help you understand that as we're going through here. Okay, so that's staying out of the one, getting into the other. I mentioned this. This is what I've done, particularly this year with Insider Plus. If we've really followed a stock, I'm trying to find something that is just absolutely blasting off. Now, as a stock trader, I've kind of come to realize, why would I ever care about stocks that aren't absolutely blasting off? It's amazing how much time I've wasted in bull markets looking for setups that took more technical skill rather than just picking the one that was absolutely shredding higher consistently, right? I heard a story at one of our Trade Surge events. There was a student who said, yeah, but you guys are just showing the easy trades. To which the response is, that's all the ones we should be doing. And what was meant by that is, well, you're just picking the ones that are just going up. It's like, well, wait a second here. If we're buying stock, those are the only ones we care about, right? Momentum, or, right, momentum on the downside. Sometimes, you guys ever gone back to a chart and you're like, man, I've been doing all this stuff. This chart's been getting killed for 6 months, right? Just getting crushed. Earlier this year, oil and gas, we just focused on that for a while because oil and gas just didn't look back. It just didn't have a downside for a while. Of course, we knew it would come in eventually, right? That's edge. That is edge, right? What if I lose 2 in a row? Okay, we're going to talk about this, but I'll come back to that. The trader, do you do what you say? Do you say what you'll do? That's an edge. I don't think we can afford to not say that 100 times as an edge. I don't know if a trader has a greater edge. The best traders I know, that is their greatest strength. They have become technicians, but they were profitable long before they became great price technicians, because they're able to control themselves really, really well. Better than me, that's for sure. I've had to learn from them. So that's a big one. All right, but back to the numbers specifically. All right, so we followed this trade earlier. Oh, this would have been last month, maybe early this month, right? There's today's candlestick too, by the way. Just bam, just right up there to those that old resistance high. Market's definitely selling off some after gapping out of the downtrend this morning. But The edge is in what? Well, let's look at this for a second. For my analyticals, right, out there, we take an entry at 65, which is higher than we actually even started looking at this, because you'll notice this was on the 50-day, and we got a decent bounce right here, which is around 64 bucks, right? Obviously the low of the day, lower than that, but around 64, 65 is pretty fair. It chopped sideways, never closed below the 50 and bounced up. Now, I wanted to show this because for starters, it's a really clear pattern. It's a really clear pattern. This is not hard to see, right? It's not hard to make sense of this. Sometimes we get so caught up in market tone, it's hard to make sense of trading in general, because market tone can change. We include news. We're talking about fundamentals. Fundamentals of what? Fundamentals of the economy. I like that stuff. Jared and I were even talking about it yesterday. He's like, man, I don't know how into this macroeconomic stuff you are, but here's a really interesting article. And he sent me an article. And I said to him, you know, actually, I find myself having to cut myself off on webinars sometimes, because I feel like maybe I'm going too far into that economic stuff, right? Because yeah, honestly, I'm not really moving the pointer at all right now. It's not even on the screen. But perhaps, yeah, like once it gets into the black here, can everybody see that? Is that coming up? When I stop moving, it disappears. So if you're looking for it then, yeah, okay, good. If you're looking for it then, it's actually not even on the screen. It just part of the presentation mode, it disappears. So you can just see it just went away. So, you know, we can get into a lot of factors that just kind of feel confusing, right? We're not really sure what's what when it comes to market tone. And I've talked about market tone a lot on other webinars. And in short, I'll just say today, market tone is supposed to help us know how fast to drive, as much or more as it is to tell us whether we drive or not. Okay. I think that is the most helpful thing I can say about market tone. That said, right, you got an entry at 65, you got to stop at 62.50 right below those wicks, right? And an exit at 70, which is just previous high. It's not the high it hit today, it's previous high. Now this thing went wild. You know, as we looked at managing this up into here, we did talk about moving up stops and taking profits at the previous high. Part of the reason is because the market's in a downtrend. So what am I saying? I'm saying we've got a clear pattern. We've got nice, strong, bullish momentum. It's clearly outperforming, right? Not necessarily year-on-year percentages, but the pattern is moving strongly, even though the market's not, right? So it's not coming under that same downside pressure. Okay, that's good. It's got some momentum. And then setting up the trade where I'm going, all right, $2.50 to $5, right? 62.50, that's a $2.50 loss. $70, it's a $5 gain per share. It's a 2-to-1, right? If I lose 2 of these in a row, put on 2 full trades and I lose them, and then I turn around and I win 1 trade, I've broken even, right? That's 2-to-1. Of course, we want better than 2-to-1. We want 3-to-1. We've done some examples in the last little while that were 4-to-1, right? The more you do that, the better. You lose 3 trades in a row on a 4-to-1 risk return setup, right? How much have you lost? $6. Then you win the 4th one, and what happens? You just made $8. You're ahead $2, and 75% of your trades were losers. 75% of your trades are losers, and you came out ahead. How did you make that happen? Math, risk return, sticking to it, which of course gets into our stop loss conversation. We talked about that more on Market Monday last night. Because if I do all of this work and then I let stop losses get away from me, there's no way I'm going to have an edge. There's just no way. it subverts the whole thing. This is one of our coaches used to say, we have to become good losers. And that's what he means, right? Got to stop out. Got to stop out properly, which happens before we ever enter the trade, but obviously we have to execute once we enter the trades. In this case, 3 trades, you have 66% of your trades you lost. In this case, 2 out of 3. Okay. But I still, in this case, it's just a 2-to-1, right? I've just broken even, right? And in the sample size, you may have 2 in a row, right? But you may have 2 winners in a row and 1 loss. Now you're really getting ahead. So that's really important. It's a simple concept. It's in some ways, it's a foundational concept, but it gives us 2 things. 1, it gives us something really actionable and practical. And 2, it's very accessible. It's very accessible. It's not difficult to understand how that really works. And we use the pattern to give us the information we need to set that up. So let's not overcomplicate that, right? We don't need to trade every day. If you are trading with specific criteria, you're not going to find it every day. If you're saying I need to trade every day and that precedes and is preeminent over the responsibility that you and I have to find our criteria. Now we can look for those opportunities every day. That's good diligence. But we're not necessarily going to find our A+ setup every day. If we think we need to trade every day, however, then that means we will take setups that are not A+. Okay? We don't need to guess. It should have had a little slash there. We don't need to know or guess what the market's doing every day. All right? That's not our job. That's not our job. This is why Jesse Livermore talks so much about waiting. He was a waiter, right? But we can be diligent to look for them. So we tried to define a little bit of how focusing in on something specific is important. What are some of those specifics? And then allowing ourselves to wait on those specifics, because if we have them and we can apply them, but then we throw that out the window because we need to be active all the time, that could be the thing that's holding you back. It may not be your technical skills, guys. It may not be your trading plan. It may be that you think you need to be in there too much. Start right there. You say, well, that's pretty simple. Good. Good, right? Here's something to look at. Getting consistent at the foundations, right? What we've covered, working it out in a sample size, small money trading, then bigger. Jeffrey says it all the time. Trade better, then you trade bigger, right? Then what can we do? This, I hope, there's 2 sides to this coin for sure. But I want to say this so that we can understand I don't need to find more trades, okay? The scalability of the markets. I made what? $5 per share. I bought 1 share in this trade based on the setup that we showed earlier, right? And I made $5. And I say this to new students all the time. Okay, you made $5. Did that change your life? Well, it should have, because you made money with money, right? But do we need to learn a whole new skill set if we want to make more? No. The leverage of the markets is that I can infinitely scale them and I can instantly scale them. Now, that is one of the dangers. The markets, Warren Buffett said this, people overtrade because the markets are so liquid, right? It's so easy to get in and out. And once you've broken the ice and you know how to get in and get it out pretty easy and you're getting confident and comfortable with that, that's where we have to begin to manage that sometimes. But that doesn't take this off the table. The scalability of the markets is that I can do the exact same trade, and instead of making 5, I make 50. Now, do I have to put in more money? Of course. Does the risk change? Yes. Right? but I don't have to go find a whole new trade. And the point here, 100 shares, that's now a $500 trade. I have to position it to my account size, right? I have to have risk that I'm willing to take. Those are still on the table. The point of the slide is to say, what if I worked on consistency more than quantity? And I don't have a problem with quantity as long as it's qualified in the ways that we've talked about, right? Working a sample size is fine, but you have specific criteria for your sample size, and we don't go outside of that. But this illustrates that I don't necessarily need more trades, right? So when we say something like we don't need more trades, we just need better trades. We need trades that are set up properly, and then we can scale them. That's where my activity can be focused instead of finding a lot of trades that draw me away from specific criteria. Okay. Now, obviously, position sizing matters, right? We're talking about the foundations. We're talking about having an edge. I mentioned already, Dr. Jim told me the number one mistake he's always seen is that we have too much money in our trades, too much money. We say, well, yeah, Blair, but you just showed us sizing up. Doesn't that mean more money in the trade? It does. I want us to balance that. We are working towards sizing up in trades because we're consistently applying that edge, right? We're following our rules. We have our rules. And we are looking to size up instead of trying to find a bunch of trades or over trading, trading every day, that kind of a thing. At the same time, right, I need to understand what the risk I'm willing to take, right, in terms of my position size. I'm going to just pop these up here for starters, right? This is the first stop loss. I don't know who initially said that. I heard some of the other coaches saying that our position size is our first stop loss. I just think it's a great quote, right? But I need to execute enough trades for a sample size, keep them consistent for a strategy for a time, right? I'm not sizing up immediately. I won one trade, boom, I'm going huge. No, I'm consistently over time showing that I'm applying an edge on a specific setup. That means I'm going to take wins and losses. Doesn't mean all wins. But again, going back to that example I mentioned from some of Jeffrey's people in the TGE program, this was years ago, right? Even the small goals that they reached consistently gave them confidence to begin to bring that up, right? They're just working in percentages. As a rule, as a guideline, right? A plumb line, even you might say, if you're going over 5 to 10% of an account size, now this depends on the strategy, and it's really coming down to the risk. But this is what we call the risk of ruin theory, right? When you look at a specific position size and you go, all right, if I lost all of that for whatever reason, right? I forgot to check earnings. It could be anything. Right? And you lost all of that. How many times could you weather that? It's just a good question to ask yourself when you're thinking about position sizing. Okay. We're not thinking position sizing when we trade from the place of profit primarily. Again, the previous slide is there to highlight that the scalability of the markets means we don't need to go out and find 100 trades. We need to execute 10 well, because the scalability can get us ahead over time. That doesn't mean I take unlimited risk just to hit bigger numbers, right? It's a left leg, right leg. They balance each other. We need two legs to run, I like to say. You don't know which ones will be winners, so keep yourself in the game. That's what position sizing does. See, all of these things, this is like a survey of edge, right? All of these things matter. And maybe just one of these pieces is the piece that you go, you know what, I haven't been focusing on that one as much. Now, just before I get out of here, run out of time here, I can see it's 11:55 already. I'm blown away by that. If Misty's still with us, she can go ahead and pop the link in the chat there, and we've got a new and improved step 1 course. We've redone this step 1 course that's coming up. Some of you guys, this will be a good place to get really into the meat of it, getting back to the basics. It's totally redone, so that's going to be exciting. I talked about this already, scalability. I'm going to keep moving here, right? The advantage is in you. The advantage is in your numbers. The advantage is in your plan. I'm going to go back. Typically, whatever your temperament is, whatever your strength is, the way your brain works, you'll gravitate to one or the other, right? So my challenge for us today is to go, all right, which one could I put a little bit more attention to? Which one could I get back to the foundation on, right? You might be a marvelous technical analyst, okay? But your emotions are getting in the way, right? You might have your emotions in check, but you didn't realize that you could do positive risk return like that, right? I could give you any number of combinations. I hope you've picked up some things along the way there that give you an idea of what you could focus on and just some encouragement to get back to the foundation of it. Maybe this current market season has just been confusing, and getting back to some basics of, I'm just going to go back to looking for great patterns, man. And those are the only trades I'm going to take. And when the risk return is stellar, there, I've got myself a trade. And maybe because this environment is so crazy at times, I'm going to wait for even better risk return than I normally do, right? Those are some things that we can think through as we move along here, all right? Tamika, you will receive that, right? Elizabeth, she's in our Master Trader program, right? We've got people on here in different programs. Will that new step 1 be included in there? You know what? I believe so. I believe it will be. There's an updated one. You'll always have that. Yep. Misty said yes. Step 1 is included. So for many of us on here, you're going to have that anyway. Okay. Some of us on here, you haven't started yet. You've never done this. Okay. That's step 1. That's the way to go. Any questions? Just open it up to questions now. Any questions as we've gone along here? I hope this has given us some good food for thought this morning. If we've been thinking on one side, we can start to think a little bit on the other side of the coin. And we'll try to land right in the middle. Maturity's in the middle, as they say. I had a mentor when I first got saved. He said, Blair, nobody's happy. He's a pastor for 35 years, double doctorate. He said, Blair, nobody's happy with me. I'm not crazy enough for the charismatics. I'm too conservative for the charismatics, he said, and I'm too charismatic for the conservatives. I thought that was so great. Just right in the middle, man. This, to me, this is the kind of stuff, when I go and I look at some of the YouTube university stuff, there's plenty of information. I just don't see the breakdowns in what really makes traders move forward. I just don't see that. So I hope you guys were blessed by that. Jimmy, appreciate you. Thank you. All right, guys, I'm going to go ahead. I'm going to hang out just for, let's see, it's 12:01. We'll just hang out for just a few minutes. If anybody has any questions for myself or Misty, you can fire those in. Please feel free. Thanks for joining us today. Feel free to log off. You guys can drop and get on with your day. Enjoy the fall weather that's come upon. Sounds like most of us. Appreciate you for being here, of course. And let us know if there's anything that we can do for you. That's what we're here to do. Okay?